In the intricate world of finance, a swap is like a friendly agreement between two parties to exchange cash flows or financial instruments. Imagine it as a barter system, but for financial assets. This exchange occurs over a specific period and the terms are predefined, ensuring clarity and transparency for both sides. Swaps are like customized agreements tailored to meet the specific needs of the parties involved. They provide flexibility and control, allowing businesses to manage their financial risks and capitalize on market opportunities effectively. Whether it's managing interest rate volatility or mitigating currency fluctuations, swaps offer a versatile toolkit for financial maneuvering. These agreements are not limited to a single type. They come in various flavors, each serving a distinct purpose. Some common types include interest rate swaps, currency swaps, commodity swaps, and credit default swaps. Each type caters to a specific financial instrument or goal, adding to the versatility of swaps in the financial landscape. By understanding the fundamentals of swaps, businesses can unlock a world of opportunities to optimize their financial strategies. Whether it's reducing borrowing costs, hedging against uncertainties, or diversifying investments, swaps provide a valuable tool for navigating the complexities of the financial world. Let's delve into the different types of swaps that grace the financial markets. Interest rate swaps take center stage, allowing parties to exchange interest payments. For instance, a company might swap its fixed interest rate payments for floating rate payments or vice versa, to better manage its exposure to interest rate fluctuations. Next, we have currency swaps, facilitating the exchange of principal and interest payments in different currencies. This comes in handy for businesses operating internationally as it helps mitigate risks associated with currency exchange rate volatility. Imagine a company with operations in both the United States and Europe using a currency swap to manage its euro and US dollar exposures effectively. Commodity swaps involve exchanging a fixed price for a floating price of a commodity, such as oil or gold. This is particularly useful for businesses dealing with commodities, as it helps them hedge against price volatility and secure a predictable cost for their raw materials. Lastly, credit default swaps act as insurance against the risk of a borrower defaulting on their debt. In this scenario, one party makes regular payments to another party, which agrees to cover the loss if the borrower fails to repay their debt. This type of swap gained significant attention during the 2008 financial crisis. Understanding the nuances of each type of swap is crucial for businesses to leverage these financial instruments effectively. By carefully assessing their specific needs and risk appetite, companies can select the most suitable swap to achieve their financial objectives. Let's dive into the specifics of interest rate swaps with a practical example. Suppose Company A has a loan of 10 crores at a fixed interest rate of 8% per annum. However, Company A anticipates that interest rates might fall in the future. To take advantage of this prediction, Company A enters into an interest rate swap with Company B. In this swap agreement, Company A agrees to pay Company B a floating interest rate, say the SBI MCLR rate on the notional principal of 10 crores. In return, Company B agrees to pay Company A a fixed interest rate of 7.5% per annum on the same notional principal. Now, if the SBI MCLR rate falls below 7.5%, Company A benefits by paying a lower floating rate while receiving a fixed 7.5% from Company B. Effectively, Company A has converted its fixed-rate loan into a floating-rate loan through this interest rate swap. This allows Company A to potentially reduce its interest expense if interest rates decline as anticipated. On the other hand, Company B might have a different view on interest rate movements or might be using the swap to manage its own interest rate exposure. This example highlights how interest rate swaps can be used to effectively manage interest rate risk. By exchanging fixed and floating interest payments, companies can align their interest rate exposure with their market views and risk appetite. The flexibility and customization offered by interest rate swaps make them a valuable tool for businesses seeking to optimize their debt portfolios. Companies engage in swaps for a myriad of reasons, primarily to mitigate financial risks and capitalize on market opportunities. One of the primary motivations is to hedge against interest rate volatility. As interest rates fluctuate, businesses with fixed-rate loans or investments can use interest rate swaps to convert their exposure to floating rates or vice versa, depending on their outlook on interest rate movements. Another reason is to manage currency risk. Companies operating in multiple countries face exposure to fluctuations in exchange rates. Currency swaps allow them to lock in exchange rates for future transactions, reducing uncertainty and potential losses from adverse currency movements. For instance, a company expecting to receive a large payment in US dollars in the future can use a currency swap to lock in a favorable exchange rate today. Furthermore, companies might utilize swaps to gain access to certain markets or instruments that might otherwise be inaccessible or expensive. For example, a company might use a swap to obtain financing in a foreign currency at a more favorable rate than it could achieve directly. Lastly, some companies engage in swaps for speculative purposes. By taking positions based on their market views, they aim to profit from anticipated movements in interest rates, exchange rates, or commodity prices. However, it's important to note that the speculative trading involves higher risks and requires careful consideration. In conclusion, swaps serve as powerful tools for companies to manage their financial exposure and potentially enhance their profitability. Whether it's hedging against risks or seizing market opportunities, understanding and utilizing swaps effectively can be instrumental in navigating the complexities of the financial world.